Simple interest is the most straightforward form of interest you'll ever meet. You borrow a certain amount of money, let's say $1,000, and the lender charges you a fixed percentage each year based only on that original amount. If the rate is 5%, that's $50 a year. No tricks, no extra layers, no interest on interest. It's like agreeing to pay your friend a flat fee for lending you their bike. Every year you have it, you give them the same amount, whether it's 1 year or 10. The calculation never changes. That's why simple interest is common in short-term loans, some personal agreements, and certain bonds. It's predictable and easy to budget for.
So if you borrow $1,000 at 5% for 3 years, you pay $150 in total interest. You could work it out on the back of a napkin. The catch? Simple interest is almost extinct in modern banking. Most lenders prefer compound interest because it earns them more over time. Still, understanding simple interest is important because it gives you a baseline for spotting when compounding is eating into your wallet. In real life, if you see a loan or savings product that clearly says simple interest, it usually means lower costs for you if you're borrowing and slower growth if you're saving. It's the vanilla version of interest, stripped of all the fancy and often expensive extras.
Once you see how clean and predictable simple interest is, you'll understand why the next type, compound interest, can be both the best friend of your investments and the worst enemy of your debts. And that's where things start snowballing. Compound interest. Compound interest is where money starts to behave like it's alive. It doesn't just grow, it grows on its own growth. You start with $1,000 at 5%. After the first year, you earn $50. So now you have $1,050. In the second year, you earn interest not just on the original $1,000, but on the $50 you already earned. So your interest for year 2 is slightly more than $50. And the cycle keeps repeating. This is why Albert Einstein supposedly called compound interest the 8th wonder of the world. Whether he actually said it or not, the point stands. It's powerful. In savings and investments, this snowball effect works in your favor. In debt, especially credit card debt, it works against you and fast. Here's the scary part. If you owe $5,000 on a credit card at 20% annual interest and don't make payments, that balance can more than double in just 4 years. The same math that builds fortunes also builds financial nightmares.
If you've ever wondered how someone's retirement account quietly triples over decades without them touching it, the answer is compound interest. And if you've wondered how a small debt turns into a monster, it's the same answer. Once you understand this snowball effect, the next question becomes, how fast can that snowball roll? That's where compounding frequency, daily versus monthly, completely changes the game.
Daily versus monthly compounding. Compounding isn't just about the rate, it's about how often it happens. This is the quiet detail that makes a huge difference over time. If your interest is compounded monthly, the lender adds the interest to your balance once a month, then starts charging interest on that new amount. Daily compounding? It's doing that every single day. On paper, the difference between daily and monthly might seem small. For example, $1,000 at 5% interest compounded monthly will grow to about $1,051.16 after a year. With daily compounding, it becomes roughly $1,051.27. That's just 11 cents more in 1 year. Not exactly a fortune, but stretch that over 20 years and the gap gets bigger.
Here's the twist. When you're borrowing, even tiny differences hurt. If you have $10,000 credit card debt at 20% interest compounded daily instead of monthly, you're paying interest on a balance that's constantly inflating, making it harder to dig out. For the bank, this is perfect. For you, not so much. This is why lenders often advertise low rates while quietly using daily compounding to squeeze more out of you. On the flip side, if you're saving or investing, daily compounding is your ally. It means your money works for you more often.
Fixed interest rates.
A fixed interest rate is the financial equivalent of a locked door. Once you step in, nothing changes. If you borrow money at 5% fixed, it stays at 5% for the entire term, no matter what happens in the broader economy. Your payment schedule doesn't shift, your monthly interest doesn't spike, and you can budget with total certainty. This stability is why fixed rates are so common in mortgages and car loans. If you're buying a house, a fixed rate means that for the next 15 or 30 years, you know exactly what you owe each month. It protects you from the shock of rate hikes, something that can happen fast if central banks raise interest to fight inflation.
But there's a trade-off. If market rates drop significantly, you're stuck paying the higher original rate unless you refinance, which can be costly. That means someone with a variable rate might suddenly be paying less than you. Still, for many borrowers, the peace of mind is worth the potential extra cost. Fixed rates also make lenders think carefully about long-term risk. If they lock you in at a low rate and inflation or market rates rise, they could lose potential profit. That's why fixed rates are often slightly higher than the starting rates of variable loans. They're pricing in stability.
In a volatile market, fixed interest can be your safety harness. In a declining market, it can feel like a missed opportunity. But if you value predictability over chasing the lowest possible rate, fixed is usually the smarter choice. Of course, not everyone chooses stability. Some are willing to gamble on rates moving in their favor. That's where variable interest rates enter the picture, and they play by a very different set of rules.
Variable interest rates are like riding a financial roller coaster, sometimes thrilling, sometimes stomach-turning. Instead of staying fixed, the rate changes over time, usually tied to a benchmark like the prime rate, LIBOR, or a central bank rate. When that benchmark moves, your interest rate moves with it. The biggest appeal: variable rates often start lower than fixed rates, making loans or mortgages look very attractive at first. That low starting rate can mean smaller payments and easier budgeting, at least in the beginning. But here's the catch. If the benchmark rate climbs, your payments can suddenly jump, sometimes by hundreds of dollars a month.
For example, imagine taking a variable rate mortgage at 3% when market rates are low. 2 years later, inflation spikes and the central bank raises rates. Your 3% might become 6%, doubling the interest portion of your payment. That's not a slow, gentle increase. It can hit like a sledgehammer. Variable rates make sense if you expect rates to stay low or if you plan to pay off your loan quickly before big changes happen. But if you're in it for the long haul, you're essentially betting on the future of the economy. And even professional economists get that wrong. Lenders love variable rates because they can adjust to protect their profits when rates rise. Borrowers like them when they gamble correctly and ride a wave of low rates. But in uncertain economic times, they can turn a manageable debt into a nightmare fast.
Annual percentage rate, APR, is the number lenders hope you don't fully understand. Unlike a plain interest rate, APR includes not just the cost of borrowing, but also extra fees and charges rolled into one yearly percentage. It's the truest way to compare loans because it tells you what you're really paying, not just the headline rate. Let's say two lenders offer you a $10,000 loan at 5% interest. Lender A charges no fees. Lender B charges a $500 processing fee. On paper, both have the same interest rate. But once you factor in that $500, Lender B's APR is actually higher, meaning the real cost of borrowing is worse, even if the interest rate looks identical.
Lenders are legally required in most countries to disclose the APR for transparency, but they still advertise the lower, prettier interest rate in big bold letters. The APR usually appears in smaller print, tucked away where you have to look for it. If the interest rate is the headline, the APR is the fine print turned into one honest number. And once you know how to read it, you'll spot bad deals instantly. But knowing the APR is only part of the story. How interest works changes drastically depending on whether it's debt you owe or savings you grow.